Good evening, everyone, and welcome to today's webinar on Market Insight for Fixed Income. We'll be analyzing the key trends and the opportunities shaping the fixed income market. I'm Sandeep Solanki, Product Specialist, and I'm joined by our Head of Fixed Income, Mr. Anurag Mittal, to dive into the insights and perspective on the fixed income markets. Following update from Anurag, we'll open the webinar for Q&A. However, you may keep posting your questions during the webinar in the link provided. So without any further ado, let's get started. Over to you, Anurag.
Hi, good day, everyone, and thanks, Sandeep, for the introductions. So like Sandeep said, we were discussing key market trends which were happening in February, what they mean for the year ahead, and what it means for us as investors. So when the year started, if we would recall, our annual outlook for the year was that chaos is a ladder. We kind of were anticipating this year to be quite chaotic given the change in U.S. administration, and we were of the opinion that probably whether it's growth, inflation, or any key macro trends, they will probably not be linear. So we, skip back and really see how the year started. So when the year started, there was a huge, I would say, view that probably this will be exceptional for the U.S. economy, given that the new administration was looking to deregulate, looking to cut taxes, and also looking for new tariff deals with the rest of the world, which meant that probably it will be negative for the rest of the world, and it will be very strong for growth for the US. And of course, US inflation expectations went up, US rates went up in anticipation that probably Federal Reserve will not be able to cut as aggressively as it was planning earlier. And how things change. So in just 1 month post January, things have totally changed. What's really happening is that China, especially post the introduction of DeepSeek, China looks to be quite ahead on AI. You have Europe, which after the change in government in Germany is talking of huge fiscal stimulus for defense and other spending. And even now, European outlook is looking better. And on the other hand, you have US outlook, which is looking slightly weaker because of the business uncertainty due to tariff negotiations. So we will delve into this. So to start with, how global economy is performing. So if you look at the left-hand side of the chart, which is the JP Morgan Global PMI, we can see the trend which has been happening perhaps since the last 4 or 5 months. So the manufacturing has been seeing an upturn, where now the manufacturing PMI is well above 50, now at 50.6. Whereas if you look at services PMI, we saw the trend that after a very strong and robust growth since 2023 end, now it has started to come down, although it's still in the expansion zone, which is 50 plus and above. But nevertheless, it's starting to slow down as more and more uncertainty on migration, on tariffs, etc. come about, and consumers start to also improve their savings order. If we look at how it is manifesting in contribution of various economic regions to global growth, if we see the chart on the right hand side, and if we look at the amber region, which was the contribution of US to global growth, we are seeing that probably it is moderating every year ahead in 2025 and 26. And if you look at the contribution of other emerging economies, which is the dark green, that's increasing slightly progressively. So broadly, what we are seeing is that compared to just 2 months back, where the whole world was with the view of US exceptionalism and US growth, now that is starting to reverse, and now people are reverting back to the view. If we look at the 2010 to 19 average, most of the growth was coming from China and other emerging markets. So if we go back to where now major economists are predicting global growth, they're largely predicting growth from emerging economies and some growth from China. One of the reasons why the outlook on US has become bleaker is that the US president has proposed reciprocal trade tariffs from 1st of April. But broadly, what reciprocal tariffs mean is slightly unclear at this point. But what the US president has said is that the tariffs will not be just at the effective tariff rate for with the particular country. They will also take into account the indirect taxes, or the biggest indirect tax in any commodity, which is VAT or GST for India, as well as non-tariff barriers such as subsidies or other government support mechanisms for any export item. So which is leading to a lot of confusion, a lot of uncertainty amongst major trading partners that when the reciprocal tariffs are announced, will it one be product to product, or whether it will be weighted average on a country to country, or whether and how exactly will value added tax, or for example GST for India be computed? Will only the value added portion be computed, or it will be assumed at a flat rate of the total value? Nevertheless, if we look at various permutations and combinations, and if we look at the major trading partners of US, if we look at all across, it's the other trading partners which run much higher tariffs on the US than US on them. For example, if you look at for India, for example, right now India levies about 9.5% weighted average tariff on the US, compared to US, which levies about 2.5%. And if we were to add all the non-tariff barriers as well as VAT, that goes all the way to more than 30%. So we and that is where the confusion is coming from for the rest of the world, that how exactly will these be implemented. Perhaps it will take a large amount of bilateral negotiations with each of the trading partners before these tariffs are really fully formed in letter. But till that time, the private sector, given the uncertainty, probably will reduce their long-term capital investments. From a more medium to long-term perspective, we think that whether in near term, in whatever shape these tariffs or reciprocal tariffs are implemented, we still think that economies with large fiscal buffers, such as China, or economies which have a large domestic orientation. So while it's true that some exports of India to the US may become slightly uncompetitive, but overall, given the large domestic orientation of India compared to rest of the economies that you see in this chart, India should be relatively better off. So, for example, if you look at Korea, China, Argentina, Thailand, which are some of the other competing economies on which US is proposing to levy tariffs, we are much more domestically oriented than. So overall, we do not see any major impact, of these reciprocal tariffs on India compared to the rest of the world. If you look at how commodity prices have been behaving, so while it's been a mixed bag, if you look at the Bloomberg Commodity Index, it's been flat, but largely, there has been material divergence within the commodity sector. So, for example, you have oil, which had fallen about 5% on weaker growth concerns, but you also had industrial metals such as copper, nickel, aluminium, etc., which saw pickup in demand as the traders are preparing for the US tariffs. So there was a sudden importing interest from the US to import these commodities before the tariffs come into play, and that is why there was a sudden price rise for many of these industrial metals. We believe that once the clarity on tariffs are there, probably the prices for industrial metals will stabilize. If you look at the food prices index, which is the UN food index that you see on the right hand side, global food prices were up 8%, largely driven by increase in sugar, dairy, and vegetable oil prices. The UN food agency also expects that global rice production should remain robust this year, while wheat production is only expected to increase marginally due to dry conditions in Eastern Europe and the US. We are also seeing extreme heat wave conditions compared to the typical weather in India as well at that point of time. So weather forecasters are really watching this event and how this impacts our crops, production, crop yields, and this may remain a key monitorable for RBI as well going forward. If you look at overall global inflation, as we can see on now, on the left-hand side of the chart, most of the inflation across major global economies is aligning, perhaps with the exception of Japan, which is seeing increase in inflation. If you look at the nature of disinflation, so broadly, your food and energy prices have come back to pre-pandemic levels, and those trend rates have re-established as supply chains have normalized. Your global service inflation is also moderating, but still it remains, above pre-pandemic trends that we saw in the first slide also, where we saw that services, though they are moderating, they continue to be in expansion zone until, there is a strong service demand. Probably we are likely to see some amount of service inflation going ahead as well. The other thing which market participants are really looking apart from service inflation is that how this tariff and immigration laws really pan out and what kind of impact they do have on labor markets, as well as on the disruption in supply chains and what kind of impact it has on inflation. So probably, yes, we've seen the best of disinflation. Further disinflation back to 2% levels, which is a long-term target for many of these economies, will really depend on how fast the tariff negotiations take place and the uncertainty is removed from global producers. If you look at the bond yields, for example, for the US, where we saw a huge pickup in yields post the change in US administration. If you look at US 10-year, it moved from 4.17 in November to almost 4.6% in December. Now it has almost back to the November levels, where now market participants are realizing that US growth may not be as strong, and probably given the uncertainty on tariff as well as on immigration, it will be very difficult for US businesses to undertake further investments till they have this clarity. And probably that is why, if you look at the growth outlook, it is weakening, and that is why bond market is seeing strong rally, at least in the month of February. The same we saw for most of the economies, apart from I would say amongst the major economies. Japan was an exception, where they continue to see higher inflation, as well as on the China, although there the inflation is behaving quite well, but unfortunately to support the economy, they have been doing larger fiscal stimulus, and that has led to larger bond supply, and that led to some technical readjustment in the yields. So those were the two larger economies which saw some pickup in bond yields, but broadly. Last month was we saw a narrative shifting, where from a narrative of strong global growth, we are now moving towards a narrative of moderating global growth compared to last year. The same is getting reflected in financial conditions index as well as market implied policy rate forecast. So if we see on the left hand side, the financial conditions are again easing in February because of the rally in US bonds, because of the growth concerns. And if you look at the market implied policy rate forecast, as computed from interest rate swaps, earlier the market participants were expecting less than 50 basis of rate cut from the Federal Reserve, given expectations of much stronger growth. But if you look at the current, shape of the curve, now market participants are almost expecting 3 rate cuts from the Federal Reserve because of concerns on basically US growth. Coming to Indian trends, if you look at, after a long time, Indian inflation has started to come down. If we look at from, October to December period, average inflation was around 5.6%. And if we look at January CPI inflation, it fell to 4.3%. The main reasons was the fall in food inflation, which was really driven by fall in vegetable prices. So as we can see, vegetable prices fell from a 26.6% YOY growth in December to 11.3%, and they should continue to fall at least till the summer season. If you look at the core inflation, that also remained quite well in control, below 4% at 3.7%. So we do expect inflation to align to RBI's target of 4% in Q2 FY26 due to base effects and moderation in vegetable prices. If we look at the trends and cost push factors which really drive food inflation, which is rural wage growth, or whether you look at international crude prices, which also determine fertilizer cost, that also is quite benign. So we do expect overall headline inflation to remain quite steady and around RBI's target of 4%, at least in the next 6 months, which basically opens up more space for monetary easing. Even if you look at the quality of inflation through the CPI diffusion index, which basically describes total constituents which saw 5% or more inflation, as we can see in the last 6 months, overall, even the percentage of constituents which are experiencing more than 5% of inflation have remained around 30% and remained quite steady for a while, which shows that a large part of inflation basket is still experiencing very moderate inflation. And as vegetable prices are expected to come down, we should see a decline in headline inflation as well. So if you look at Rabi sowing, the Rabi sowing season has got concluded. Overall, Rabi sowing has been quite well compared to last year, about 1.5% up YOY. If we look at season to date rainfall since 1st October, which is the starting of Rabi season, it is about 60% below normal levels. The positive thing about at least this season is, unlike last year where reservoir levels were quite low due to weaker monsoon, thankfully this time the reservoir levels are actually above last year, apart from some regions in north and eastern part of India, but largely the reservoir levels are above last year as well as above long period average. IMD has highlighted that March 25 will witness high temperatures, which can affect the wheat crop. So probably RBI as well as market participants will be really watching over that how wheat prices really get affected in future. Given that our wheat stock has also come down in the last 3 years as government has been doing open market sales of the wheat crop, we really need to see how retail prices for this really pan out in next 3 to 6 months. And that is something probably RBI will also be watching quite closely. So if you look at even the US Department of Agriculture data, which is on the right side of the chart, which discusses the global production as well as global consumption of wheat crops. If you look at the closing stock for wheat compared to rice, it is on the lower side. Whereas if you see for rice, it is about 35% of total annual consumption, whereas for wheat it's just 8%. So the buffer in wheat is quite low. So probably that's something which the market participants will be watching out for in near future. GDP data for Q3 FY25 was released, and if you look at both GDP as well as GVA, they both increased at 6.2% YOY. The biggest driver for increase in growth, was if you look at the change in private consumption, which grew from 5.9% to 6.9%. If you look at the expenditure data, even the government consumption, as the election-related uncertainty and the election-related freeze were lifted, we saw pickup in government spending as well. Of course, exports also did quite well, in Q3 FY25, led by overall service exports. If you look at the net exports, they were at 7-quarter high. If we look at agriculture also, that also did quite well on the production side, growing at 5.6% compared to 4.1% in Q2 FY25. Manufacturing is something which remains quite low, still at 3.5%, although it is an improvement from 2.1% compared seen last quarter. We are still not seeing major pickup in manufacturing despite growth in consumption, and that's something probably which will also keep RBI worried, and that's something which probably will be in RBI's mind when they look at the next policy, to ensure that rates are more favorable given the fall in inflation. If we look at the liquidity measures by RBI, since the change of guard at RBI has become very, very proactive in liquidity infusion. So one of the reasons why we were seeing tightening of financial conditions in India was not only actually on the sovereign side, but on the corporate bond and money market side, where we saw 1-year CDs and even the corporate bonds, trading quite cheaply. And one of the reasons for that was extremely tight liquidity. There were two reasons behind this. I would say liquidity. One was, as we know, since October, there has been a spate of FPI sell-off in equities, which has led to RBI intervening on the FX side, and that has led to decline in system liquidity. Also, typically this is a festival season for India from October, and it usually results in increase in currency circulation. So both these factors have contributing to tightness in liquidity, where liquidity went from a surplus in September to more than 2 lakh crores deficit in January. And as a result of that, what RBI has done, if we see, has infused, longer term durable liquidity. They have infused about 1.3 lakh crores through FX buy-sell swap auctions. They've also introduced long-term VRRs, which are crossing the financial year 25. They've also infusing liquidity through 1.4 lakh crores of direct OMO, apart from their OMO interventions on the screen. So if you look at it in total, they have infused about 5 lakh crores liquidity. And if we include the CRR cut as well, they have infused about durable liquidity of about, more than 4 lakh crores. And because about 1.75 lakh crores will mature in April, but that they have done in, VRR. But broadly, the takeaway from this table is that RBI is very, very serious about liquidity. RBI is trying to ensure that financial conditions become easier. There is, also the transmission of rate cuts, which RBI has already done and is possibly likely to do. So probably this makes shorter end of the yield curve quite attractive, as the effect of these liquidity measures may be seen probably in the next quarter. So, like we saw discussed in the last slide as well, apart from the CRR cut, RBI has also undertaken various permanent liquidity measures. And if you look at the average interbank liquidity deficit, it has improved from 2 trillion, deficit in November to January to now 1.6 trillion deficit in February. If you look at the average call rate, which has come down from 6.7% in January to 6.45% in December. So broadly, yes, there was a rate cut as well, which has led to the call rate coming down. But we do expect, as liquidity improves, the call rate should further align towards the policy rate. On the credit deposit gap, as we can see, thanks to RBI's measures, overall credit growth has come down from high double digits now to close to 11.5%. Deposit growth is continuing to grow as banks, focus on ensuring their ALM profiles are, well matched. So if we see for the month of January, credit growth grew slightly higher at 11.4% from 11.2% December, while deposit growth continued to grow at 10.3%. driven by both recovery in demand as well as time deposits. If we look at the key drivers of credit growth, they continue to be services led by wholesale and real estate. If you look at personal loan growth, that has continued to slow at around 11.8%. We do expect the RBI reduction in risk weightage for NBFCs and MFIs from April 25 to boost growth to these sectors. Although at a systemic level, we do believe that ultimately the underlying asset quality will remain most critical for the banking system. Probably the reduction in risk weight will lead to some improved pricing for these NBFCs and microfinance institutions, but ultimately the credit pricing will be done on the risk perception of these NBFCs. So NBFCs which have not seen a seasoned loan book, which have grown too fast, may continue to see pricing challenges going ahead as well. On the fiscal trend, what we saw was, especially if we look at the corporate taxes, they have seen some slowdown, whereas income tax continues to go up. They were rising by 20%. If you look at the capital expenditure, that picked up quite meaningfully. In fact, that was up by 51% YOY due to the stronger devolution to states, and overall capex has now become a positive 5% from a negative number till last December. We still think that although the government has improved upon its fiscal deficit target for FY25 from 4.9 to 4.8%, we do expect even that number to get outperformed, as the nominal GDP estimate has been revised upwards because of slightly higher inflation, as well as slightly better real GDP. So probably we may see even the fiscal deficit number for FY25 to be even better than what the government had presented in the budget. On the trade deficit, we saw a marginal uptick in trade deficit number from $22 billion odd to 23 billion. Largely, if we can see, the biggest delta came from oil exports, which fell from 4.9 billion to 3.6 billion, probably due to both a combination of some lower volumes and weaker prices. But if you look at the service surplus, our service economy continues to do quite well, and our net service exports went from 19.1 to 20.3 billion. So overall, our current account continues to be well managed, and we do expect FY25 current account deficit to come below 1.5% of GDP. But we do expect INR to remain under pressure due to global uncertainty on account of trade disputes, as well as given the FPI outflow, especially in equity, probably the outlook for INR may remain slightly under a negative outlook, at least for the next couple of months. If we look at the sovereign curve, one notable highlight I would like to show to you is that the green line, especially post the 15-year segment. So if we look at last year, the curve was quite flat. So the moment you go from 6 months all the way till 40 years, the curve was largely flat, apart from a slight hump in the 12-year segment. This year, we started to call out that as RBI start to cut rates, we are likely to see some amount of steepening on the yield curve. So if you look at the January line, which is the blue line, the steepening has started to manifest in most of the segment. But if you look at now the month of February, that steepness especially come in the 30 to 40-year space, where the spread between 10-year to 30-year has meaningfully widened in this month. That was largely as expected, at least, and what a recommendation had been to investors, that probably interest rates had come down, the curve had flattened in anticipation of rate cuts. But as the rate cuts take place, it is the short end of the yield curve which is more likely to do well than the long end, at least in terms of basis points. And that's largely been playing out both in the month of January and February. If you look at the rates across the curve on government bonds, AAA and AA, what we see is widening of spreads between government bonds to Corporate bonds, typically this is expected in the Jan to March quarter because of slightly tighter liquidity and heavy issuance requirements of states as well as corporate issuers. So if we look at, for example, on the 10-year space, the 10-year AAA went from 7.17 to 7.31, despite GSEC just going from 6.7 to 6.73. If you look at the 5-year space as well, the same story continues, where the 5-year GSEC only went up by 2 basis points, but that 5-year AAA went from 734 to 743. So broadly, corporate spreads have widened, and we do expect these spreads to come down once liquidity improves in the next quarter. So broadly on the macro outlook, if you look at the macro tailwinds, they're quite constructive for fixed income. If we look, like we discussed, for the inflation, inflation is looking to align towards the RBI's target of 4%. If you look at growth, it's now come back to 6%, and it is looking to stabilize between 6 to 6.5% for FY26. And if you look at the we talked about liquidity, where we saw that RBI has infused more than 4 lakh crores of permanent liquidity in the system, and as monetary policy works with a lag, we do expect in next 2-3 quarters the benefits of this 4 lakh crores of liquidity infusion will start to show up in transmission of rates, and probably we will see rates on the shorter end of the yield curve, both in money market as well as corporate bonds, to come down with the benefit of both rate cuts and improving liquidity. But if you look at the real yields today, they are quite attractive. So if you, for example, if you take the case of 5-year AAA, which is around 734, and if you look at the expected inflation, which is moving towards 4%, these real yields are extremely attractive. They present a suitable opportunity for earning high accrual, as well as possibility of participating in capital gains as the rate cycle turns. So this is something which we would recommend to our investors. If we look at the risk reward, we believe the moderate duration products provide a better risk reward, given that we view that probably the yield curve may continue to steepen, where the 10-year and beyond segment yields may continue to go up despite the rate cuts, as they had largely corrected in anticipation, and probably may continue to see some amount of profit booking on those segments. If we look at the gap between overnight rate and money market rates, for example, a 1-year CD today is trading around 7.6%, and if you look at the overnight rate is around 6.25%, and given that we are further expecting rate cuts, in fact, the gap between overnight and money market becomes quite attractive. So for investors who are looking for more than 6 to 12 months kind of investment horizon, can consider investing to low duration money market strategies. Investors who have a more than 12 months investment horizon and some appetite for mark to market volatility can consider moderate duration products, such as corporate bond fund, short term fund, etc. Which give them decent accrual as well as opportunity to participate in capital gains with further rate cuts expected ahead. So that was it from my side. We can open up the floor to question and answers. Thank you.
Thank you, Anurag, for the insightful presentation, and we'll take the questions from here. So the first question is, like you pointed that during the month of February, yields across most maturities in the gilt securities and the spreads between corporate bond and gilt securities also expanded. So how do you see this, and what factors led to this shift?
Right. Thanks for the question, Sandeep. So broadly, what happens during the month of Jan to March is we see pickup in issuance from state governments as well as corporates, because they try to fill in their pending funding requirements in the last quarter. So typically, most of the spending, if you see from state governments, and that's been a historical trend, that typically comes in the fourth quarter. The same goes for public sector undertakings and other private sector corporates, where whatever the remaining funding requirement for these entities, they usually come in fourth quarter. And so this spread widening, I would say, was expected, that we were expecting those spreads to widen both in SDLs and corporate bonds, and typically both follow each other, because if the 10-year SDL today is coming at 735 annualized, it is likely that even the corporate bond, which is not even a sovereign security, may trade at least at the same level or slightly higher than a 10-year SDL. So that is, we believe, it's a seasonal factor. Probably in next quarter, again, we do expect a slowdown in issuance from both states as well as corporate issuers. And we do expect these spreads to correct and again narrow in the upcoming quarters.
Okay. So the next question is, the advanced tax outflows are likely to take place this month. How do you see this impacting the system liquidity in the interim? And should investors be concerned about the potential short-term market volatility, tightening liquidity conditions, or any interest rate movements as a result?
So, the expected advanced tax outflow in this quarter, which should be closer to 15th March, should be in the range of 1.6 to 2 lakh crores outflow. And we do expect outflow from GST related activities as well, which should be around close to 22nd to 24th of March, which should also be close to around 1 lakh crores. So the total outflow from due to advanced tax and GST collection should be 3 lakh crores. Some of it will come back through government spending. So it's not that the whole amount will remain with the government. Some of it will come back also into the banking system. We think it's more important for an investor to first define their investment horizon and not worry about this short-term volatility. So of course, when there is an outflow, any such outflow from the banking system, in the near term, it may lead to some mark-to-market fluctuations. But as we saw in one of the previous slides, RBI has been quite proactive. It has been doing VRRs, which is short-term liquidity provisions. It has been doing FX buy-sell swap. It has been also announced 1 lakh crores OMO, which is yet to come. So, in anticipation of these outflows, RBI had announced about 1 lakh crores OMO, which is supposed to do on 12th of March and 18th of March. So we should also see some benefit of this, RBI measures. So overall, while there may be some short-term fluctuations in next probably 10-15 days, but if you look at the quarter ahead, which is the April to June quarter, we do expect most of this tax outflow to come back as government spending and government cash balances to come down and liquidity to improve. We also expect rate cut. So we have two RBI policies in April and June. So we do expect one rate cut at least in the next quarter. We should also bode well quite for the shorter end of the yield curve. So we do expect the improvement in liquidity as well as rate cuts to drive short-term curve performance in next 3 to 6 months.
Okay, thank you. There's one theoretical question. There's the point where you mentioned about cost push factors remain benign. Can you please help us understand what are these cost push factors and how does it affect the inflation?
Right. So if you look at food inflation or any food production, what are the major components of food cost? Especially in an emerging economy like India, labor is one of the most important components of food production, as most of our food production is still labor intensive compared to the rest of the world, where it's a balance between machine and labor. The second biggest component, or one of the largest components of food prices is your fertilizer prices, which again are affected by the oil prices. So ultimately, what we were trying to say is, if you look at the rural wage growth in the last 12 months, it has been moderating and in fact at a lower level. If you look at fertilizer prices also, they have been coming down globally for most of the fertilizer components. And given that oil prices are coming down, and given that oil is a major component of fertilizer cost, so overall the outlook for fertilizer prices is also quite favorable. So what we meant was that even from a forward-looking perspective, at least these components are looking quite benign. Yes, you can't account for the weather, and we are seeing extreme weather events across the world, including India. But at least the other factors which are in control are your wages as well as your input cost for agriculture.
Thanks. Thank you, Anurag. From an asset allocation perspective, within fixed income space, what would the ideal proposed mix be between your moderate and low duration categories in the current juncture of the interest rate cycle?
So the asset allocation, see, would largely depend on an investor's risk appetite and their investment horizon. So if an investor, let's say, has a more than 1 year investment horizon and has a very high risk appetite, probably they can consider about a 80% allocation to moderate duration and probably the balance of 20% to low duration or money market just for their liquidity needs. In case they have a less than 12 months investment horizon, probably from a risk management point, they should allocate largely towards cash management and probably some allocation to moderate duration because, like we have been saying or seeing for the last 12 months, things change quite abruptly. Whether you talk in terms of how the political economy is working or how commodities are working or how the weather patterns are working. So given the very high volatility in these factors, and it's not just today. I mean, these things usually stay quite volatile in the short term. So probably for an investor who has a less than 12 months investment horizon, for them we would say money market or cash management strategies work much better. If you look at the spreads today are very, very attractive. If you look at the yields of either a low duration product or a money market product compared to overnight rates. So we believe that investors who even have a less than 12 months horizon are getting very good real yields and decent opportunity of capital gains as well. Of course, not as high as moderate duration, but we believe that given things unfold in a very rapid fashion in the shortest time frame, probably investors should refrain from investing in higher duration categories, if they're looking for a shorter term investment.
Thank you. Very well answered. Anurag, there doesn't seem to be any further questions. I think we can conclude the call here. Participants, thank you for joining us today. We hope the insights shared by our experts have given you a clearer understanding of the current fixed income markets and the opportunities ahead, and how you can adjust your investment strategies accordingly. As we know, markets are always evolving, and staying informed is crucial to making the sound investment decisions. We encourage you to continue with the conversations and stay connected for the future updates. We value your time and participation today and look forward to welcome you again in our next event. Until then, stay informed, stay ahead, and thank you again for your attention. Wishing you a wonderful evening ahead. Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.